Hey everybody, John Felici here, Security National Mortgage Company. My co-host, Sean. First things first, you might ask me why I'm dressed like, I don't know, a kegger at a frat house in the summertime. But you know what? It's 35 degrees outside and that's fine because I'm on fire, I'm pumped up, I'm motivated to help you learn what you need to know about mortgage loans. So, one question that I hear quite a bit is what type of mortgage loan is best for me? Now, you definitely have a choice of what type of mortgage loan that you want, you can do, what's available. There are more than one type of loan out there. But the truth of the matter is that most people are going to really fall into a category of mortgage loan. Meaning that depending on what your resources are, down payment, credit score, where you want to live at, things like that is going to determine really what type of loan product is best for you. So I'm just going to give you a quick overview of available loan products in this day and age. Now, you've got conventional loans, you have got FHA, VA, USDA. Those are the mainstream loans that you're going to find for purchasing 1 to 4 family residential type houses. Now, conventional loans are very good. They fit people that have more of a good and long-standing credit history and have a little bit of money to put down. Now, if you have I would say a 720 plus credit score and the ability to put down at least 3 to 5% towards your mortgage loan, conventional has some good products. For example, lender-paid mortgage insurance. Most of us know what PMI is, private mortgage insurance. Well, lender-paid mortgage insurance, when you have decent credit and a little bit of money to put down, you could potentially get out of the monthly mortgage insurance without having to put down 20%. Now, that can be a good option for some people. Now, if you have the ability to put up 20% on a mortgage loan, well, then you can do conventional and you can get out of the PMI and everything altogether. And that would be a great way to go. But in my experience in this industry, most people are not working with 20%. Now, if you're a veteran, the VA loan product is really a superior loan product to just about everything out there. You have no monthly mortgage insurance. The normal funding fee that's associated with FHA and USDA, a lot of times, depending on your level of service, disability, and whatnot, a lot of times you can get out of the funding fee that comes with VA. So it's like you could potentially get a loan with no funding fee and no monthly PMI. So of course, if you're a veteran, there's really no better way to go than the VA loan. Now, getting into the two most mainstream loan products, which would be FHA and USDA. Now, FHA, they're insured by one entity of the government, and USDA, that's not MEET, that's actually an entity of the government that insures a loan product. Now, what that means is when a government entity insures a loan product, what that means is it doesn't mean that they fund your loan. What they do is whenever your loan is approved, they set aside imaginary money. Well, it shouldn't be imaginary. It's real money, everybody, but whatever. Okay, they set aside money, to insure your loan, and that allows you to be able to buy a house with little to no down payment. It makes it to where us, the lenders who actually do fund the loan, will approve the loan on more favorable terms for you. Now, FHA could potentially, right now, go down to as little as a 500 credit score. Some of the things that would make you do an FHA loan over a USDA loan would be, first off, if you are not willing to live in an eligible area for USDA. Also, FHA allows for a much higher debt-to-income ratio. You can get by a lot, and you get by a lot higher. The credit requirements, I would say, for USDA, although USDA does go down to a 580 right now, the credit requirements for USDA are a bit more stringent. And the other thing is student loans. A lot of people out there have deferred student loans. When you have a deferred student loan, now used to, a few years back, if your student loan was deferred for at least 12 months, then you would not have to count that into your debt to income ratio. Right now, the USDA, for example, if you have a deferred student loan, basically if you have a student loan that is not set up on anything that is not a fully amortizing fixed payment, then they're going to calculate the total balance of that student loan against you at like 5%. So take the balance of all your student loans times 5%, that's the projected monthly payment, which in most people's situation with upwards of $20,000, $30,000, $40,000 of student loan debt, you're talking about the equivalent payment of financing a Ferrari. And so if you've got somebody out of school 2 years maybe, they've got a job making $45,000 a year, and I have to count $50,000 of student loans against them at a rate of 5%, $2,000 a month or something, that's going to blow them out of the water for debt to income ratio. So that person is going to have to either get on a fixed, fully amortizing repayment plan, or they're going to have to move over and do something like FHA. FHA, they're a little bit more lenient on student loans. They're going to count, the greater of 1% or what's counted on the credit report against you. So, for that reason, because the debt to income ratio goes up higher, they have a more flexible debt ratio requirements for the FHA loan. For example, USDA, I deal with this with a lot of people. USDA, the ratios on that thing, unless you have the ability to qualify for a ratio waiver, you have to stay at a 29 and 41% debt to income ratio, front end and back end, the housing expense ratio, the total debt ratio. And it's like you can't exceed. If you're at 41.1 or 41 period, you need to be at 40.999 actually to qualify for that. So, FHA, if you have the means for a down payment, and if you have the means for a down payment, maybe your debt to income ratio is higher, maybe you've got some student loans, there may be some benefit to doing the FHA loan. Now, when you're doing an FHA loan, you've got the obvious 3.5% down payment that's associated with FHA. There can be down payment assistance potentially used. There's a few places around town. There is a possibility of, getting gift funds. You can have your down payment possibly gifted to you by a relative or even possibly a close friend with FHA. But there are flexible sources that you can get down payments from in order to do that type of financing. Now, USDA, if you are willing to live in one of the eligible areas, which around Tulsa is going to be Owasso, all eligible, Glenpool, all eligible. You've got Bixby, south of 141st Street, that is all eligible. And then you've got, Broken Arrow, a lot of areas that they're in Broken Arrow, but they're in Wagner County. So you can stay in Broken Arrow schools. If you've got kids and that's what you're trying to do, you can stay in Broken Arrow schools, but, you're going to be in Wagner County. So basically things that are east of 193rd county line, and then it's kind of sparse. So if you have questions about that, give me a call. I can email you the eligibility map so that you can see exactly where the areas are, because they really jog in between 31st and 81st Street east of 193rd. But the USDA, if you're willing to live in one of those areas, you've got the benefit of no down payment. You have got the benefit of the lowest possible monthly PMI, of any loan product out there, with the exception of course, lender paid, which is no PMI, monthly anyways. So the USDA, it is a superior loan product, but like I said, it's kind of like VA. If you're not a veteran, it doesn't matter what VA has. And it's like, if you don't fit the mold for a USDA loan, nor do you want to live in a place that's eligible area, you're not going to be able to qualify for that loan either. So, like I said, if you followed me on what I said today, there are options for financing, but I really would not worry about picking what loan is right for you, because you're not in an economy, in an environment where you have to discern between adjustable rate mortgages and prepayment penalties and things like that. virtually all mortgage loans that you're out there applying for, I mean, it's almost, unless you ask for it specifically, you're going to be in a fixed mortgage loan with no prepayment penalty. It's always something you want to make sure of, but definitely anything that I do, and most of the people that I work around and with, you know, you would have to specifically ask for and then qualify for anything other than a fixed loan with no prepayment penalty. So, you know, just remember whenever you're out there looking, I mean, you know, listen to your loan officer. You're probably going to fall into one of these categories. If you've got some money down and good credit, you might be good for conventional. If you are a veteran, you're definitely going to do a VA loan. If you are, you know, high debt ratio, maybe you got some student loans, FHA is a good pick. And then, of course, you know, USDA. And now, just so that Kevin Blackburn doesn't try to correct me on this, there are actually more loan products than FHA, USDA, VA, and conventional. You know, we also got, you know, you've got Section 184 loan, which is, you know, the Native American loan. And, of course, you know, FHA 203K loan, which is a rehab loan. And there are other loan products out there. If you have, like, private banks who retain and service their own loans, you will see, you know, Quicken. I'm going to give you an example. My friend Justin and I have been blowing Quicken, Justin Demarest, that is, you know, Award Realty OK, by the way, excellent realtor. I recommend it to anybody. If you need to buy a house, that guy, he negotiates for fun, okay? So get in touch with him, Justin Demarest. But we have been blowing Quicken's 1% deal out of the water. Here's the deal with this. If you've been looking into loans, Quicken has been advertising a FRED loan or something. It's where you basically you pay 1% down. Now that sounds attractive on the surface. When someone is trying to put 1% down on a mortgage loan, what that means is they have limited funds, okay? Here's the catches with this product. Now, with FHA, for example, you have a 3.5% down payment. But the seller is allowed to pay up to 6% of your closing costs. So let's just talk in the neighborhood of a $100,000 loan. That's $6,000 bucks. $6,000 is pretty close to what your closing costs are going to be on a $100,000 loan. Now let's flip over to the FRED loan. On the FRED loan with Quicken, you're doing 1% down, but they only allow 3% seller concessions. Therefore, that other 3% that you were the other 3% that, you know, you don't have to pay for in down payment, you're going to pay for in closing costs. So then you're actually on the FRED loan, in all reality, you're out pretty much 4% versus the FHA, which is 3.5%. So if you see, not all things are the same. I mean, when you pull it out to the light, you look at everything all together, it is not the same thing. The other thing, I believe that the Quicken product, they give you a higher interest rate and there's no PMI. Once again, sounds really good for advertising purposes. But when you are staring down, you know, the barrel of an interest rate at 4.875 or 5% that allows you to forego PMI, the equivalent payment is not that great. So this is a big marketing thing. You've got a 1% down payment, you've got no PMI. That sounds wonderful. But in reality, you are paying 4% out of pocket rather than 3.5 for the FHA. And even though you don't have PMI, you are still getting eaten up on that interest rate. So your payment is still the same. So what is the benefit of this loan product? Well, I mean, not much. It's advertising. So, I mean, guys, that's why you got to talk to somebody that can explain things to you, and I mean, in simple ways that you can understand. You know, someone that's not out to try to market you. You know, I like to try to do the best that I can to explain things to people in its entirety. Sometimes that's got me in trouble because sometimes there's people that don't need to know very much, and maybe they'd be better off not knowing all the details because it just confuses them more. But the main thing is that when I'm qualifying a loan, I'm looking for a way to qualify that loan so that you're in the best possible position that you can be. I'm looking at, you know, the factors that are, you know, how does this amortize over the term of the loan? I mean, is this person, are they saving money because of this? I mean, is this, you know, what does this interest rate cost them versus how much does it save them on the monthly payment? Does it benefit them to pay this much? So everybody out there, if you've got questions, I mean, I don't care if I'm doing your loan or not. If I'm doing it, great, you're smart. If I'm not doing it and you got a question for me, just ask me. You can give me a call, 918-630-1991. You could call me at the office, 918-286-1226. You could call Sean, but he doesn't have a cell phone, but you can still call him. You could call him at 830-220-8001. Is that right, Mike Jones? I don't know. Anyways, but just get in touch with me one way or the other if you got questions, because even if I'm not doing your loan, I can still help you out. I can still answer your questions, and who knows? Maybe I might end up being your loan officer anyways, even though you got one, Maybe you just want to jump ship. Grass is greener on the other side sometimes, folks. It's just the truth. So, hey, everybody, have a good Sunday. I'm going to get out of here. I'm going to go try to do some good things. And if you guys need help, you got questions, give me a call. I'm out.